Retiring a millionaire can seem like a fairy tale, but what if it's actually more doable than you might think? The process of achieving this goal is very straightforward and can be done by virtually anyone. All it takes is a little bit of consistency and discipline from the investor, but there's a lot of questions that need to be answered, like how much should you be investing, where should you be putting your money, and how long will this all take? Throughout this video, I'll be giving you a complete step-by-step guide on how you can retire a millionaire from just one investment. So to figure all of this out, how much will you actually need for your retirement? Google says that you will need 80% of your annual income each year when you retire. So the average salary in America is $52,000. 80% of that is $41,600. Now, assuming that the retirement age in your country is 65 and you live to the age of 90, you will need 25 years worth of income if you're going to retire. Now, living to 90 is a generalized statement. Some people will live past 90 and others may pass away before that age. But we'll just stick with 90 for this example. So if you take the 25 years that you'll need 80% of your income, which was $41,600, then the grand total that you'll need for retirement is just over $1 million. So how will you actually accumulate that much money with just one investment? Moving on to where should you be investing your money? The best place for this is the S&P 500. Now this is by far one of the most profitable investments that you can make. It's just a collection of the top 500 biggest publicly traded companies in America. It includes very recognizable companies like Coca-Cola, Amazon, and Facebook. All of these have seen very consistent growth and are some of the biggest companies in the world. Now, you can't directly invest into the S&P 500, so you'll need to find an ETF or an exchange traded fund that will copy the performance of the S&P 500 index. Some of the best ETF providers are Vanguard or iShares, and they both have an ETF equivalent that will track the performance of the S&P 500. If you put the stock graphs side by side for the ETF and the index, their performance is identical because the sole purpose of the ETF is just to buy and sell all of the same companies as the S&P 500 index, leading to a completely identical performance. The S&P 500 has been providing positive returns for decades. Since the 1950s, this index has been averaging a return of 10% per year. But keep in mind that this is an average spread out over decades. Some years it'll do better than others, but over the long run, you can always expect that nice consistent return of 10%. Now that we know where our money should be going, how much should you actually be investing? Since we're looking at this as a retirement fund, the recommended amount to contribute towards a retirement scheme is 15 to 20%. We'll be a little bit more conservative and just contribute 10% of our annual income into this investment. So monthly, we would be contributing $400 if we're putting in 10% of our income on a $52,000 a year salary. So looking at how much this money compounds over different time points, over a 10-year period, your portfolio would be worth $76,499. Over 20 years, it would be $274,920. 30 years, $789,571. And then finally, in 40 years, you'd have a grand total of over $2.1 million accumulated from this investment. Now, putting in $100 a week or $400 a month seems like a very achievable task for the majority of people. And even if you can only do, say, $50 a week, then you'll still see a massive return. You can see how quickly the changes in portfolio value increase the longer the period of time that you've been investing. And it's all about consistently putting money into your portfolio and showing up week after week. This type of strategy is called dollar cost averaging, where you always put a consistent amount of money into the stock market. It removes a lot of the stress that people commonly associate with investing, like having to spend hours of their time researching a company or perfectly trying to time the market. This strategy removes all of that, and it's just looking at the investment as a secondary savings. You're not trying to pick the perfect time to buy or sell a business, or always reading stock charts or scanning over financial reports trying to find the next best company. All you're doing is just putting the same amount of money into the market week by week and letting the compounding and interest take care of the rest. This strategy was popularized by one of the greatest investors, Warren Buffett, which, as you can see, has made the majority of his money past the age of 60. So that leads me to the next point, that this strategy takes several decades or years to achieve great wealth from it. It can be quite slow or almost boring depending on the type of investor that you are. Most definitely you can retire a millionaire from VOO, but does that mean it's the best investment and the only investment that you should include in your portfolio? Personally, I would say no, because there's a lot of other asset classes or investments that you could be putting your money into that could achieve a massive return. Looking at growth stocks such as Tesla, or other asset classes such as cryptocurrency, which can double, triple, or even quadruple their value in just 1 to 2 years years, meaning they can provide over 10 times the return of the S&P 500 in just a 1-year period. But with these massive increases in price, there's huge fluctuations in the value of these investments, sometimes having drops of 50 to 80% on quite a regular basis. So there's a risk versus reward tolerance from the investor based on how much risk they are willing to take with their money to try and achieve a more impressive return. With the S&P 500, you're only getting exposure to well-established blue chip companies that have seen the majority of their growth already and are now just seeing a very slow and consistent increase in their value. In comparison to growth stocks or cryptocurrencies, which are more in their infancy stage of development and therefore take less money to increase their value and can see more rapid price changes, which can be appealing to a lot of investors. Personally, I would say that putting about 20% of your money into these other asset classes and leaving 80% in a diversified ETF can be a great strategy when you're getting into investing. If you're interested in learning about some of these other asset classes like cryptocurrency and growth stocks, make sure to check out this video on screen so you can make a more informed decision on which investments are the best for you. If you've made it this far into the video, make sure to drop a like for the YouTube algorithm. Make sure to subscribe if you want to see more videos like this.